Home Depot, HD, had a nice bounce off the 200-day moving average last week and closed at the daily high on Friday. HD is rated weak buy and the Barkhart technical opinion rating is a 24% buy with the weakest short-term outlook on maintaining the current direction. Rather than just buying the stock, savvy traders can use the options market to find smart ways to trade Home Depot stock without risking too much capital. Today, we're going to look at a couple of bull call spread trades with different expiration dates. Here are the parameters for finding some bull call spread trade ideas on HD. Symbol equals Home Depot. Probability above 40%. Moneyness -5% to 5%. Days to expiration 30 to 150. Let's analyze some of these ideas. Bull call spread 1, April 355 to 400 bull call spread. As a reminder, a bull call spread is a bullish defined risk option strategy. To execute a bull call spread, an investor would buy a call option and then sell a further out of the money call. Let's use the first line item as an example. This bull call spread trade involves buying the April expiry 355 strike put and selling the 400 strike put. Buying this spread costs around $19.45 or $1,945 per contract. That is also the maximum possible loss on the trade. The maximum potential gain can be calculated by taking the spread width, less the premium paid and multiplying by 100. That give us 45 to 19.45 x 100 equals $2,550. If we take the maximum gain divided by the maximum loss, we see the trade has a return potential of 131.36%. The probability of the trade being successful is 41.1.9%, although this is just an estimate and does not indicate the probability of achieving the maximum profit. The spread will achieve the maximum profit if HD closes above 400 on April 14th. The maximum loss will occur if HD closes below 355 on April 14th, which would see the trader lose the $1,945 premium on the trade. The break-even point for the bull call spread is 374.45, which is calculated as 355 plus the $19.45 option premium per contract. Bull call spread 2, May 360 to 380 bull call spread. Let's take the last line item as our next example. This bull call spread trade involves buying the 360 May call and selling the 380 call. Buying this spread costs around $11.05 or $1,105 per contract. That is also the maximum possible loss on the trade. The maximum potential gain can be calculated by taking the spread width, less the premium received and multiplying by 100. That give us 20 to 11.05 x 100 equals $895. If we take the maximum gain divided by the maximum loss, we see the trade has a return potential of 81%. The probability of the trade being successful is 56.9%. The spread will achieve the maximum profit if HD closes above 380 on May 20th. The maximum loss will occur if HD closes below 360 on May 20th, which would see the trader lose the $1,105 premium. The break-even point for the bull call spread is 371.05, which is calculated as 360 plus the $11.05 option premium per contract. Mitigating risk. With any option trade, it's important to have a plan in place on how you will manage the trade if it moves against you. For a bull call spread, setting a stop loss of 50% of the premium paid is a good idea. In the first HD example above, that would be a loss of around $920. For the second example, the stop loss would be around $550. Trader may also consider a stop loss if HD breaks below the 200-day moving average. Home Depot is due to report earnings on February 22, so traders these trade would have exposure to that event.